Oh my gosh, the market is on fire, and we're going to talk about the market, but first I have to apologize because I screwed up. I didn't do a Meet Kevin report this morning. I had a Meet Kevin report scheduled, and I woke up at 3:50 to do it, but I couldn't do it. I couldn't do it because this is somewhat embarrassing, and this rarely happens. It happened yesterday. I think it's out of our systems, but basically, we in the staff may have set up a LAN party and had like a 14-hour rest raid. So in other words, I got like zero sleep until about like 3 a.m. and then I'm like, cool, I'm gonna get like 45 minutes of sleep, and I'm like, no problem, we could do it. So I'm up at like 3:50 and I'm staring at my 2 coffees, and I'm like, so PCE comes out soon. Let's look at the forecast. This rarely happens. It happened, and I apologize. Yeah. So anyway, let's now, but hey, you know what? I think it was good. It was our entire team. It's kind of cool, you know, because we basically just took the office and turned it into a LAN party. I think once in a while that's healthy, that's good. Too often it's a problem. But once in a while, you know, pizza and then smoothies afterwards and LAN party, that's fun. And this was fun. This was really fun. So I really enjoyed it, but I do apologize to the viewers. Now we got to get back to hard work. So, with that said, I just came from a 93-minute course member live stream. We're going to talk about some of these things, but in that we went through a detailed analysis on companies that are running today, like your C3 AI, your UiPath. We talked Google, we talked ASICs, we talked Tesla chiplets, we talked, I mean, everything, servers, AI, and what the HE double hockey sticks is going on in the market. You know, everybody's already heard the news about the Tesla-Ford partnership. That's great. And I think there'll be more of that. I think the big hidden thing about Tesla that is probably not being prioritized by Elon right now, I actually think that if Elon were less, this is an example of where I think, yes, Elon is distracted by Twitter, but I think if Elon were less focused on Twitter, he would see this opportunity. There's a massive opportunity in potentially using Dojo, their basically custom-made server stack for AI compute, renting out basically their server for AI compute and making servers, and then competing with your not only Amazon and Google and Microsoft server stacks, but also making the actual chip. That would be a vertically integrated data center, a game changer for Tesla, because it would be a completely new vertical that people would have to price in. A completely new vertical. So dear Elon Musk, if there's one thing to consider doing right now, it would be creating a vertically integrated server stack specifically for AI. Use the Tesla Dojo. That side of the business, even if you have to fundraise for it, will self-fund. The stock market will give you the money you need to do that. So please, if you think Dojo is as powerful as you all suggested on AI Day, even though y'all are, for some reason, I don't know, maybe somebody can explain it to me, using 7-nanometer chips produced, manufactured by TSMC. You're designing these chiplets yourself, which is great. You're not even operating these AI servers, Dojo, on GPUs, which are extremely expensive. You're running them on your own chiplets, which is awesome. And so why not make a chiplet AI data center? You say you're an AI company, right? And suggest that FSD is just totally undervalued by the market. Well, let's double and triple down on it. So I don't know, maybe nobody's suggested that, but there's a real possibility that creating this sort of server stack could be a multi-$100 billion market cap opportunity for Tesla and a massive revenue driver. Because now, if you can, I mean, think about this. An NVIDIA H100 costs you $30,000. And we talked about this a little bit in the course member live. Actually, we talked about it a lot. But we were comparing ASICs and GPUs and CPUs and stuff. But so quickly going to some of these notes from the course member live, which remember you get lifetime access to. Just join any one of the programs linked down below. You'd want to do that before June 1st because we're releasing the course, the AI stuff then, and then the price will go up again. But anyway, one of the things we were talking about was some of the differences between GPUs and ASICs and that. Don't worry so much about that. What you more want to worry about is that your typical AI server right now looks something like this, or maybe you have two CPUs, which are, think of it as like the brain of the server, and then your workhorses, like your motors or the GPUs. And the GPUs right now, the winner, the fastest, most efficient 4 nanometer chip right now is your nvidia H100. That's these guys. And you spend about 30 grand on each of these. If you have 10, that means you're spending 300 grand on these GPU stacks. And on these CPUs, you're spending maybe 15 grand. So you're outspending via GPUs on a 20-to-1 ratio your AMD CPUs. Now we do know that AMD also makes GPUs. We know that, obviously from the PC gaming side. But their server GPUs are, they don't hold a candle to the H100s. Let's just put it that way. So we know that. We've talked about that already before in plenty of other videos. And we've looked at sort of the cost differential between the time-based usage of these. But more important is that, and this is more market broad important, we'll move on from Tesla because I do think there's a huge opportunity here for Tesla and Dojo with their custom server stack, right? I think Dojo, if you looked at it, would look a lot more like you'd have your brain, your brain up here, and then under that, you'd actually have endless interconnected, they call them chiplets, to do tasks. And if these can be as flexible as GPUs, which that could be a probable downside for Tesla, is if they're not flexible like GPUs and they're not programmable, given that NVIDIA has the CUDA moat, then perhaps that's where the downside is. And perhaps that's why Tesla can't pull this off with the chiplets. Maybe they don't have the flexibility. Maybe they're good for FSD data, but not everything else, right? So that would be your big downside. Maybe, I don't know, but maybe they are flexible. Maybe somebody can enlighten us on that in the comments. With that said, though, so Tesla out of the way, with that said, obviously AI is driving the market today. It's driving the market so much so that you're actually seeing,
oh, we're back to the blackboard. Why would we be back here? Well, it's because of this word nobody likes. Bills. I'll tell you, if you want bills, buy a plane, because I just did, and there are endless bills, and I'm tired of them. I wish I could just lower my bills and see all the bills I had to deal with in one place, and that's where Rocket Money comes in. See, Rocket Money's mission is to meaningfully improve the financial health of millions of people and empower you to finally reach those financial goals by canceling your unwanted subscriptions, lowering those bills, and seeing everything in one place, as well as monitoring your credit and helping you see a holistic view of your finances. Now, Rocket Money is a paid sponsor on the channel, and one of the reasons they're a paid sponsor here is because obviously as a licensed financial advisor, somebody who teaches about a financial education, real estate investing, stock investing, making more money, building your wealth, learning how to make more money with artificial intelligence, I'm all for finding ways to maximize your income and minimizing your expenses. And if you could reduce your bills, minimize some of those subscriptions you forgot about. Canceling subscriptions, big a deal. Set a budget and monitor your credit all in one. Well, this is a platform you might want to give a shot at. Especially since Rocket Money is an all-in-one personal finance platform that helps you save more money and spend less. So consider supporting the channel and the Meet Kevin reports you get here totally for free, and check out the link down below for Rocket Money. Now, back to the content.
Another rate hike being priced in. Now, this is fascinating because if you look at the 5-year break-even rate, it's at 2.18. It's near lows, and it's really stopped rising. If you look at the news that came out this morning on the University of Michigan Consumer Sentiment Report, phenomenal. Why was it phenomenal? Because the expectation was we were still going to have that de-anchoring of inflation expectations, that we were going to get 4.5% on the 1-year out inflation horizon. What do we got? We got 4.2. We're going back, which is a sign that you had this temporary surge of inflation fears because of the energy cycle of April, the sort of rebound that we got, and even into May. This year over year, oh my gosh, Pepsi raised prices nonsense, which we've already broken down many times. Most of those price increases happened in the first half of last year, not the first half of this year. That means the pricing power is really fading, and the true pricing power will come from what I've been banging the table on, which is innovation and chips. Software's tough. We'll talk about software in a moment. C3AI, I'll give you a little note on these. But think about this for a moment. University of Michigan, good. So great on inflation expectations, still anchored. 5-year break-even expectations, anchored. PCE, just like the last CPI, came in 1/10 hot on core month-over-month at 0.4. And month-over-month headline at 0.4 as well. 4.8, obviously well above 2%. We know that. But what's happening is you're just seeing the economy keep cranking. Durable orders coming in at 1.1% instead of the expectation of negative 1%. Companies are spending money again. Capital good orders are exploding. Capital good orders, excluding air and then just looking at non-defense style, not like defensive style stocks, like not military and not aerospace. What did those capital good orders do? Machinery, like CNCs, like lithography machines for chips. What did they do? Survey says negative 0.1. Actual says 1.4. We're seeing companies spend because they realize we're not going into a deep, dark recession. Instead, you need to spend money to invest in your company so that going forward, you don't get left behind. In a weird way, and we talked about this in yesterday's course member live stream, I actually think there's this likelihood of seeing, and I know it sounds crazy, but seeing companies hire more people in the short term and then refine in the future. That's because companies don't want to get left behind on this Nike swoosh recovery of this next decade. It's real. Yeah, look, is there still a possibility of going into a recession? Maybe. But with all this new AI spend, business investment is not going anywhere but up. Business investment is going up. The consumer is still strong. The data we're getting does not say recession. It does not say the Fed has over-tightened. So the Fed has a choice. Do they go for pause on inflation because inflation is trending down and risk it reinflating? Or do they go for another 25 BP hike? Well, so far, it looks like the market is pricing in. Now, today, it flip-flopped another 25 basis point hike. In fact, we're at about a 67% chance of a 25 basis point hike in June. And now here's what's crazy. If the Federal Reserve chooses not to hike because Jerome Powell said, hey, we're sufficiently restrictive, we're good. You know, we'll be data dependent, but we've reached the level of being sufficiently restrictive. If the Fed pauses when the market is actually expecting a hike, you know what emoji symbol that's going to look like. Rocket ship. And if you're a short seller, you best beware. Now, if the market's pricing in a 25 BP hike and we get a 25 BP hike, nobody cares. Now, obviously, the market is trending up also not just because of AI, but because of this debt ceiling stuff. Like we talked about yesterday, Republicans focusing on, hey, let's just cut spending for the IRS rather than cutting SNAP food program benefits or worker requirements. Well, duh, everybody can get behind that. Who in their right mind, what American is going to say, yeah, would you rather cut money from poor people who need to get a leg up, even if there's abuse in the system, even though there are entitlements? Would you rather cut money from poor people who are just trying to eat and put food on the table and get a leg up on the crappy situation that they might be in? Probably are. I don't know what the situation is. But would you rather cut money from them, or would you rather say, hey, let's take a little bit of money from the IRS back? Come on, man. Everybody hates the IRS because they take your money. Now, that's what we sign up for. That's okay. You can't be bitter about the IRS. I was super bitter because my biggest earning year ever, maybe one day in the future we could repeat that, but obviously that's not now. My biggest earning year ever, 2021, I paid like 55% in taxes. It was insane. It was like $11.7 million of taxes gone. And so then it's like, oh my God, that's a lot of money. So, anywho, so obviously I think that would be popular to limit what you would see from this debt ceiling negotiation and some of the drama, where if everybody can get behind this idea of, okay, let's give some of this money away from the IRS, and it's a popular thing, boom, all of a sudden debt ceiling done. Now there's talk about kicking the debt ceiling down the road for 2 years, which means you don't even have to worry about it during the presidential election, which means you're kicking the can down the road to 2025, which would be good because you don't want to go through this crap again right before an election cycle, because it probably lowers voter turnout and makes people become even more disenfranchised with the political system. So, okay, debt ceiling talk over, Tesla talk over. Now, what about all these software companies going to, oh yeah, and of course the Fed talk over. Do keep in mind, I always like paying attention to also what's going on with the Fed and specifically your treasury yields. So we're going to talk about treasury yields and software next here. So let me first interject treasury yields. Treasury yields up because the economy is still doing well. You're sitting at 3.8% on the 10-year treasury. Now, what industry is that most problematic for? Real estate. Even though real estate is still doing just fine, because we have still yet to see the surge of inventory. Still no summer surge of inventory. It looks like higher for longer is not affecting the stock market. It's going to affect the real estate market. So that'll create some interesting opportunities, which I'm excited about for HouseHack, now my real estate startup. But we'll see. So far, median sale prices just ticked up again. So, people don't seem to stop buying because there's so little inventory. Look at this active inventory chart. You ready for this? This is insane. You look at the active inventory for real estate. Look at this. Your active inventory is, if this continues and we do not see the surge in inventory, let's see, we're at 950,000 for 2022. Right now we're at 730. Let's say we're at 750 in 2 months. 750,000 listings divided by 950, inventory would be down 21%. That's why prices aren't falling. I mean, they did fall, peak to trough, which was May to December. But now we still have this uncertainty of like, okay, well, what happens next? Well, inventory stays low and prices basically slowly start rising again, or inventory starts rising as rates stay high, and that's your worst case scenario. So there's certainly uncertainty. We can be certain of uncertainty in real estate. But where's another area that is seeing a lot of sort of almost SPAC-like euphoria, which in my opinion is somewhat ludicrous, some of it. Where are we seeing some of this SPAC-like euphoria again? Well, in my opinion, it's companies like C3AI. Now, UiPath has substantially better fundamentals than C3AI. But both of these companies, specifically UiPath, great financials, guiding flat revenue. For a growth and SaaS company, nobody wants to hear flat revenue. The problem is, we do not know which software companies are going to be the absolute beneficiaries of AI. What we do know is that the winners of AI are going to start with the users, the businesses and the end users. We know servers will win. We know manufacturers of server equipment will win. So, going down the chain, we know every business that uses AI wins. Any business that doesn't use AI will get left behind. Literally why I have this coming out, right? How to be more productive yourself as an employee, an entrepreneur, doesn't matter, with how to make more money and get SH&IT done faster course. Check that out. Join by June 1st, because that's when we're doing our lecture drop. And I'd love for you to be part of that. It's going to be incredible, and we'll learn productivity in AI, and we'll consistently update it as well. And you get access to the course member live streams, where you get this incredible deep dive analysis. Remember, we had 93 minutes this morning on debating and talking and researching. It's really phenomenal. But anyway, and that's like every day the market's open too. Usually not that long though. Today was a little extended. But anyway, so C3AI, okay, so we know that businesses and users will win from AI. Anybody who doesn't use AI will lose. We don't know which software companies will win, though we think that it'll probably be companies like cloud providers like Google and AWS and Microsoft. The downside is how much of their businesses are actually going to get hurt by AI at the same time as benefit from AI, like Google Search. Google Search and network placements, like 69% of their revenue. Well, if 69% of their revenue drops at 10% a year, that's $5 billion a year of revenue that's going away. And even if you go from $1 billion to $2 billion of just AI ad revenue, great, you're up 1, down 5, you're net down 4. That bleeds Google's revenue. Now, I would never bet against Google as a user, but as an investor, I'm nervous because I don't know how that revenue bleed is going to look. The company's done great, though, over the past few weeks here because of AI, and obviously, it would take years to see that bleed. So, short-term bullish, long-term bearish? Maybe. Okay, so now we look at, and then of course you have your NVIDIAs, your AMDs, your Taiwan Semiconductors. These are phenomenal. Make sure when you're doing fundamental analysis on TSMC, you understand that ADR shares, the ones we invest in America, are 5 times as valuable as the Chinese listed shares. Keep that in mind. Otherwise, your numbers will look real funky. Anyway, so then you look at, the software stacks. And the reality is most users and businesses are just going to flip-flop to whatever business provides the best AI product. And now that it costs basically nothing to start an AI business, how could you bet on software, any individual software company, when tomorrow there could just be a better software company? All of them will use the data centers, the servers, the chips, and all the users and businesses will win. But the one segment that is most at risk is the software stack. So that does make me very nervous for the software stack. And so when I see this sort of like euphoria in some of the stocks, it's like, hey, it's fine. That's fine. Rising tide lifts all ships. No problem. Plenty of my stocks are doing absolutely phenomenally. With the exception of like Enphase, which is stuck in the hole, which is probably honestly because of that uncertainty in the real estate market. Because if you think about it, rates are high and they're going up. You're at your all-time high for mortgage rates this year. And that makes it harder to borrow for these sort of investments into your home. And then, of course, you still have uncertainty over where the real estate market's going to go. So let's put all these pieces of the puzzle together. While understanding the pieces of the puzzle, we are clearly in a situation where we might entirely avoid a recession because of artificial intelligence. And it's not just because, oh my gosh, it's ChatGPT. It's because of the business investments. Just a few weeks ago, I reported on a Goldman Sachs piece that suggested we would go into a recession not because of consumer spend, because that's resilient and actually strengthening. We would go into a business-led recession because businesses would spend less on CapEx because rates are so much higher for businesses. Businesses are the ones who pay interest rates like that. Yeah, well, now with AI, businesses would be like, we can't afford not to keep investing, even if rates are higher. Okay, interesting. So, literally. Anyway, so this sets up a fascinating potential of entirely avoiding a recession, but not just avoiding a recession, having a disinflationary GDP boom. Disinflationary because we're past the COVID money printing, but also because AI is disinflationary by the nature of it. It's actually deflationary. It makes companies more productive, and it allows GDP to expand in a non-inflationary way. It's the best case scenario. It's literally like if you could have in 2021, in November of 2021, given the market a magic pill, an antidote to high inflation and stagflation, you would have created something that would have let GDP expand rapidly in a way that massively increases productivity and does not cause inflation. Quite literally, that is what AI is. It's mind-blowing. Now, I understand there are a lot of people who still believe that all this AI stuff is just hype. That's fine. Look at business CapEx investments over the next 9 months. They're going to explode. They're going to explode because businesses cannot afford to be left behind. And they realize this is not a metaverse where you're buying virtual real estate or some garbage. This is actual, at every person's desk, more productivity. Every employee becomes more productive because of this. It's mind-blowing. So that said, this is fantastic news for the Nike swoosh recovery. This is fantastic news for potentially avoiding recession. And quite frankly, the market might look at another Fed rate hike and go, bring it on. Is that all you got? I mean, look at the NASDAQ. We have now retraced quite well. We bounced off the floor, 253. We had some uncertainty around inflation and Paul Volcker leading us to 289. We got rejected by 311. And once we finally broke 311, we went straight through the 330 resistance, didn't even stop. Now we're getting rejected at 348, which is literally where the QQQ is sitting right now. The downtrend is clearly over, and now you're clearly on a uptrend. In fact, you actually just broke the uptrend, which is insane. Let's modify the uptrend slightly here to align. No, you want to kind of keep it here. Yeah, no, I'm just going to extend it is what I'm going to do. So is it possible that we retrace on the NASDAQ back to a 330, maybe on a hot inflation report for May? Yeah. That would be potentially your fall down to about a 330, right? But yeah, this is absolutely a remarkable time. And so we'll see. So I suppose in conclusion, Tesla, if their chipsets are adaptable, they should be considering getting into the server space, potentially, if they could do it cheaper and more effectively with their dojo. Or if it's not adaptable, then forget about it. Just use it for your own AI and autonomy. And hopefully more brands wake up to Tesla, and Tesla becomes like an Apple CarPlay for charging and for full self-driving. The full self-driving is already extremely good. And you really can't have an opinion of Tesla full self-driving unless you've used Tesla full self-driving. Okay, that's one. 2, be cautious of software. 3, probably be bullish on AI and what it means for the economy and potentially avoiding a recession. Great. And then last, don't worry about the debt ceiling. And instead, ask yourself, why have you not joined these programs? You know, somebody left me a comment the other day like, oh, I haven't joined yet because I don't care about real estate. There's a Stocks and Psychology of Money group. There's a How to Make More Money, Entrepreneur and Individual Worker Productivity course. Because remember, there's investing and then there's making more money. Those are two different things. Investing, we have Stocks and Psych. Yes, then there is a 0 to Millionaire Real Estate course, which is different, and a property management course, which is different, which includes rental renovations and recommendations and product recommendations and that. All of them include access to the course member live streams. But then you've got the How to Make More Money course as well. So check all of these out. Really excited to share all the content, and you get the full archive of all the course member live streams. Just make sure you join before June 1st. Okay, folks, thank you so much for being here, and we'll see you in the next one. Good luck out there. Now, I want you to know this. When it comes to AI, time is what's going to make you money. And if you can prove that value to an employer, you'll always be able to be employed. So this is another way of making sure that you don't get replaced